Hello, everybody, and welcome to the UK Mortgage Market Insights for the week ending Friday, the 26th of June, 2026. I hope you're all well. Right, so this week there's a lot to cover, and I want to get straight into it because we've had massive movement from lenders this week, and I mean proper chunky rate reductions across the board. We'll look at what's driving that, what the latest swap rate data tells us, and what it means if you're thinking about buying or remortgaging. We're also sitting in the middle of a heat wave that's got people reaching for the factor 50. And as it happens, that's not the only record being broken this week because we've got the big political story. 7 prime ministers in 10 years. Britain has broken its own modern record for political instability. We'll also touch on what's happening in the Middle East, where a ceasefire agreement has been signed between the US and Iran, and why that matters to your mortgage more than you might think. And finally, a proper deep dive into Andy Burnham. Who is he? What does he actually think about stamp duty? And what could it mean for buyers and homeowners if he becomes Prime Minister? There's a lot to get through, and if you find this useful, please hit subscribe. There's new content every week, so let's get straight into it. Let's start with the rates because this week has been genuinely busy. The list of lenders moving is long. Principality, Skipton, Bank of Ireland, West Brom, Leeds Building Society, TSB, Barclays, Accord, Coventry, NatWest, Fleet Mortgages, Nationwide and the Mortgage Works. And these aren't token reductions either. Principality and TSB are both cutting by up to 0.5%. Coventry and Skipton are reducing across the board. Accord is cutting rates on both residential and existing customer buy-to-let. NatWest is moving on existing customer rates, and Nationwide and TMW are reducing too. West Brom is targeting 2-year products on both purchases and remortgages. So, what's driving all of this? Well, obviously swap rates. If you're new to the channel, swap rates are the underlying cost of fixed rate money for lenders. When swap rates fall, lenders can offer cheaper fixed rates. When they rise, rates go up. It's as simple as that. Last week, the 2-year swap was sitting at 4.003%, and the 5-year was 4.021%. This week, the 2-year has dropped to 3.923. That's a fall of 8 basis points, and the 5-year has come down to 3.957, around 6.5 basis points. Not dramatic on the face of it, but in the context of where we've been over the last year or so, the direction of travel is really clear. Swap rates are heading south and lenders are following. That's why you're seeing a wall of rate reductions this week. And I don't think this is a one-week story. There are reasons to believe rates will continue to ease over the coming months, which we'll come back to. Now, moving on to the political situation, I mentioned records at the top, so let me come back to that. We're in the middle of a heatwave right now. Britain being Britain, it's the main topic of conversation everywhere you go. But it's not the only thing breaking records this week, because Keir Starmer has resigned as Prime Minister, and that means the UK is about to have its 7th Prime Minister in 10 years. 7 in 10 years. In the modern era, that is a record. By comparison, the previous 4 decades had 6 Prime Ministers in total. We've matched that in a single decade. The last time Britain churned through leaders at anything like this pace was back in the 18th century. And back then, the whole system of government was barely recognisable compared to today. Cameron, May, Johnson, Truss, Sunak, Starmer, and now whoever comes next. Quite a ride. And I'm not making a political point here. This isn't about which party or which individual. The point is simply this. Political instability makes people nervous, and nervous people don't buy houses. When people don't know what the rules are going to be, when they don't know who's in charge or what policy is going to change next, they wait. They sit on their hands. They tell themselves they'll move when things settle down. And that is understandable. But here's my view. Waiting is actually the wrong move right now. When the market is quieter, there is less competition for property, fewer buyers chasing the same homes, and that means that you have more negotiating power, more time to think, and sellers who are often more willing to do a deal. That window doesn't stay open forever, because once political uncertainty fades, and it always does eventually, confidence returns. Buyers come back into the market and competition goes up. That's when you find yourself in a bidding situation, paying more and wondering why you just didn't move 6 months ago when the market was quiet. Do I think rates are going to fall dramatically and soon? Honestly, not dramatically. Inflation is still above target. The bank held at 3.75 in June, there's an energy price cap rise coming in July, and the conditions for big rate cuts just aren't there yet. So anyone waiting for rates to fall to 3% before they buy is likely going to be waiting for a very long time, and doing so in a much busier, more competitive market. Now is a sensible time to move. That is my honest assessment. Now, just a brief update on the Middle East, because this has been feeding through into mortgage rates and the wider economic picture since the conflict began earlier this year. The situation has been moving quickly. The US and Iran signed a memorandum of understanding on the 17th of June, intended to bring the conflict to a formal end within 60 days. A ceasefire between Israel and Hezbollah in Lebanon was also agreed on the 19th of June, following pressure from the Trump administration. It's fragile. There have been violations on both sides, and the situation in Lebanon is still complicated. But the direction of travel is towards de-escalation, and that matters for us here. Why? Because the conflict disrupted global energy supplies, pushed oil prices up, and contributed to the inflationary pressure that has been keeping the Bank of England cautious about cutting rates. If the ceasefire holds and energy markets stabilise, and on that point the price of oil per barrel has now dropped to levels pre-Middle East tension, that removes one of the key arguments for keeping rates higher for longer. Now, it's not a done deal, but it's worth watching, and it does form part of the case for why the rate environment could ease further over the coming months. Right, now for the main event, Andy Burnham. So he won a by-election last week, he's back in Parliament, and he's a strong favourite to become the next Labour leader, and therefore the next Prime Minister. So what does he actually believe in when it comes to property taxes? Now, before I get into that, I've got two things in common with Andy Burnham. We're both Northerners, and we both think stamp duty needs serious reform. So I'm coming at this with a degree of sympathy for the argument, even if I've got some questions about his specific proposals. But let's start with the stamp duty itself, because that's the question I'm already seeing from clients. Burnham has been vocal for some time about stamp duty being outdated, and in his words, one of the most regressive taxes that we have. He doesn't like it. He thinks it penalises mobility, much like I do. It stops people from moving to take a job, downsizing when kids leave home, or upsizing when a family grows, because every transaction comes with a significant tax bill attached. And on all of that, like I said, I agree with him. Stamp duty in its current form does penalise movement. It discourages downsizing. It adds a cliff edge cost to an already expensive process. I've been saying this for years, that it's a tax that works against the housing market rather than with it. Where it gets more interesting is what Burnham proposes to replace it with, and that's where I have a few more questions. What he's pointed towards is a land value tax, a recurring annual charge on property values rather than a one-off transaction tax. The specific version doing the rounds from a campaign group called Fairer Share that Burnham is said to be sympathetic to would replace both stamp duty and council tax with a single annual levy equivalent to around 0.48% of the property's value. On a £300,000 home, that's about £1,440 a year. On a £500,000 property, you're looking at around £2,400. On a £1,000,000 home, just under £5,000 a year. Compared to the current system, that works out better for cheaper properties and worse for expensive ones, particularly for people who bought years ago, have seen their home appreciate significantly, and are now asset rich but income poor. For them, an annual charge linked to current value could be genuinely difficult to manage on a fixed income. For first-time buyers and home movers, on the other hand, no big lump sum to find at the point of purchase is a meaningful change. It could make moving less financially brutal. Now, and this is important, none of this is a manifesto commitment. Burnham hasn't been elected yet, and even if he becomes Prime Minister, radical reform of property taxation would face serious resistance from the Treasury, from homeowners, from the press, and likely from within his own party. These reforms have been talked about for decades, but they rarely happen. The most likely outcome, in my view, is some tweaking of stamp duty, perhaps higher thresholds or restructured bans, rather than wholesale abolition. That's the path of least resistance politically, but it's worth knowing this is the direction of travel, and it's a good reason to have that conversation now rather than waiting for clarity that may never quite arrive. So pulling all of this together, what does it actually mean if you're thinking about buying, remortgaging, or even selling? On rates, the direction is down. Swap rates have fallen again this week, and lenders are competing hard. If you're coming off a fixed rate in the next few months, now is a good time to explore your options. You don't have to wait until your deal expires to start looking. On the political situation, don't let it spook you into inaction. Markets are quieter right now, and competition is lower, meaning sellers are more motivated, and that combination doesn't last and it won't last once confidence returns and a new Prime Minister beds in. On stamp duty, nothing is changing imminently, but if you've been waiting to see what happens, the honest answer is that nobody knows, and waiting to find out could mean waiting a very, very long time in a much more competitive market. And on the Middle East, if the ceasefire holds, that's a tailwind for inflation coming down and for the Bank of England to ease rates further later this year, and that's good news for borrowers. My view this week is the stars are actually aligning rather nicely for anyone considering a move. Lower rates, lower competition, and a property market that is more sensible to navigate than it was 18 months ago. The instability in Westminster is real, but it doesn't change the fundamentals of bricks and mortar. Now, I'd love to hear your thoughts and comments on any of the topics that we've covered this week, so please do leave them below. If you haven't subscribed already, please do so because we produce this content every single week and it's important that you keep up to date on what's happening in real time. Thanks so much for watching and I'll see you next week. Take care.